back. We'll talk some more about that. But we've got to move on. As I say, there's a lot of interesting corporate news out there for us this morning. So let's get into the NN Group, the company delivering a net profit line for the first half, a little over 2 billion euros here. The first half operating profit coming in at 983 million euros. The expectation was for 961.6 million. The group value of new business, 254 million. That is up 5% here. The group says it is on track to meet financial and other targets. Let's catch up with the company. The CEO, David Knibbe, joins us now. David, good to see you this morning. How do you feel about the numbers?
Yes, good morning. Clearly, as you already laid out, we had a strong business results in the past 6 months. Our operating capital generation, which is the key target that we aim for, went up 15% to 899 million. We set a target of 1.5 billion for 2023, so we're clearly very well on track to deliver that. And some of it was also supported by higher rates, but I was particularly pleased also to see that the new business is growing. You already mentioned that our value of new business is up 5%. Netherlands did very well, but also the European markets and Japan have been very resilient in not an easy time. So overall, yeah, these are strong results, and we're well on track to get to the targets that we set for next year.
Karen and I, as you heard, were just discussing the inflation numbers in the United States, and obviously the focus everywhere at the moment is what the impact of inflation is going to be on household incomes and overall demand in the economy, and ultimately whether central banks are going to react by suppressing that demand further with higher interest rate increases. How much does that affect your view of the likely performance through the second half and into the early part of next year? How are you baking that into your modelling?
Right. So for inflation itself, by itself, is very manageable for us. We have the inflation that exposure that we have on our balance sheet is very well hedged with inflation-linked bonds or swaps. And so there is some upward pressure from expenses, obviously. About 50% of our P&C portfolio is sensitive to inflation. We haven't really seen it, to be honest. We have already started to reprice and will continue to reprice to anticipate some of the inflation that no doubt will come. On the disability side, we took an extra reserving of around 25 million. So we're very well prepared, I think, for the upcoming inflation. I think the biggest concern is actually going into the fall and next year is that a lot of the markets that we operate in have 15% inflation. If you see Central and Eastern Europe, there's around 15% inflation. And clearly salaries are not keeping up. And that means families will have less purchasing power. They will have less to spend. And I think so the base case is more of a recession. So on the one hand, that will put some pressure on our new business and on our portfolios. But we've seen also in the COVID times that if new business is low and economies slow down, that the business model can very well sustain that. And to be honest, also the higher rates also supports our investment results. So overall, that's why we're still very optimistic that we will achieve our targets.
The Solvency II ratio movement to the downside, you mentioned that this was due to some of the market volatility. In particular, you pointed to the widening of Dutch mortgage spreads and also the lower equity markets. Do you think we're through the worst of it when it comes to some of the volatility we've witnessed on these asset classes?
Well, I think our base case is that we'll continue to see a lot of volatility. We've always maintained a very high solvency ratio because we knew that this type of volatility could happen. So the 196 ratio that you mentioned is very much in line with the rest of the industry. We assume that volatility will continue to be there also in the fall, not just on inflation, but also with a potential economic downturn that is coming. But we're very well prepared for that. And the reality is also that though higher rates and this volatility puts on the one hand some pressure on our Solvency II ratio, the capital generation actually also goes up. And this is also why you have seen that our capital generation went up 15%. And that obviously over time also adds again to our solvency.
David, can I ask you about the mortgage portfolio? I can see there's 4.9 billion euros of new mortgages in the first half of this year. How does this compare to other cycles we've seen before in terms of the new business you're expecting to write in mortgages, but also just how conservative you feel like you need to be at this point, given credit quality has been fairly strong across Europe in recent months and years, in fact?
Yes. Well, the quality of the Dutch mortgage book has always been very high. The loan-to-value has come down to 55%. We see actual losses has always been below 1 basis point, and spreads have significantly been widening. So currently they're well above 200 basis points. So that means that the mortgages that we've been writing, the 4.9 billion, have been at a very attractive margin from a risk-return perspective. Going forward, we do expect a slowdown of the mortgage market. There's been a lot of refinancing because of the lower interest rates. That obviously is that pattern is changing, and there's also a relatively shortage of houses in the Netherlands. So the amount of transactions that is expected to go down, and therefore I also expect a slowdown of the Dutch mortgage market, not because of the quality, but simply because of the lack of transactions or the lack of houses that we currently have in the Dutch market.
David, let me squeeze in a quick ESG question, because I can see that you've invested more money in climate solutions, targeting for 2030, 6 billion euros, the additional amount that's slated. There's been a big debate as to whether climate change goals have been pushed out to an extent because we've got a war in Ukraine, energy security front and centre with this energy crisis playing out. Are you witnessing any slippage as you're also committing more money at this point?
Well, it's definitely a concern. I mean, one of the big targets that we have is reducing the coal. So we all like electricity, of course, but if it's generated by coal, then net that is still a real problem in terms of carbon footprint. And because of everything that's happening with the UK, there is, of course, a tendency now that more coal has to be used, which is understandable. At the same time, this is a concern from the perspective of the carbon reduction that we need to do. So as a company, we set not only targets for Paris, but we also set targets for 2025 and 2030 to reduce our carbon footprint of our investment portfolio with 25% already in 2025 and in 2030 with 45%. So clearly there's a big challenge, and this is also why we're stepping up our investments. We want to invest in the front runners, but also we step up our investments in climate solutions, because some of this that is currently happening is understandable, but it has to be offset by alternative ways of energy, and that's why we're stepping up our investment in that area.
Good to see you, David. Thanks for joining us at this hour. David Knibbe, the CEO of NN Group, on the company's first half numbers. Still